Welcome to the Deep Dive. We're the show that cuts through the noise, gets right to the core insights from, well, usually a whole stack of sources.
That's right.
And today we are diving deep into a name that's almost mythical in investing, Warren Buffett, the Oracle of Omaha.
Synonymous with success, really.
Exactly. You've definitely heard the name. Maybe you follow his moves. But have you ever really wondered, how did he do it? What actually makes him different?
It's a great question. And often, the public focuses on the later stuff, the really big deals.
Right.
But if you want to understand the journey, our mission today is to dig into not just what he did, but how his ideas, his principles evolved right from those very early days.
From selling chewing gum, basically.
Pretty much. How he built this massive conglomerate, Berkshire Hathaway, and maybe most importantly, how his thinking goes way beyond just picking stocks. We've pulled together, a ton of articles, transcripts, notes to try and give you the clearest picture.
Okay, let's do it. Let's go right back. Omaha, Nebraska, 1930. Born right into the Great Depression era.
Yeah, that context is huge. It definitely shaped his view of money.
For sure. And he wasn't, born with a silver spoon, but his dad, his grandfather, they were business people, role models. So what was he actually doing as a kid? What were these first ventures?
Oh, he was a hustler from day one, basically. Started super young, going door to door selling chewing gum, made 2 cents profit a pack.
Wow. 2 cents.
Then Coca-Cola, 5 cents profit on a 6-pack. He did magazines, newspaper delivery routes, even pinball machines.
Pinball machines, really?
Yes, set up a route. And get this, by the time he was in high school, he'd already saved up $5,000.
Which today is like, what?
About $50,000.
Oh.
And he sold one of his little businesses for $1,200 before he even graduated high school.
That's incredible for a teenager.
Yeah.
So it wasn't just about earning cash. He was figuring out how money works, how to make it work for him.
Exactly.
Which brings us to that key idea, compounding. And there's that great story about Harry Larson and the weighing machine.
Oh, yeah. It's a classic Buffett anecdote. So, 1933, this guy, Harry Larson, sees people using a penny scale at a drugstore.
Okay.
Finds out the owner gets 25% of the profit, maybe $20 a month. So Harry thinks, okay, takes $175 he saved, buys 3 machines himself. Soon he's making nearly $100 a month profit.
Nice.
But here's the kicker. He then uses the pennies from those first 3 machines to buy 67 more.
Ah, so he's not just pocketing the profit. He's rolling it over, turning pennies into more penny-making machines.
Precisely. And that light bulb moment, profits aren't just for spending, they're for reinvesting, for exponential growth that became Buffett's core principle, not just for interest, but for building businesses.
Yeah, using profits to make more profits, compounded.
Exactly. He literally said he imagined buying 1 weighing machine, using the profits for more, soon having 20, everyone weighing themselves 50 times a day. He saw that was where the real money was, the compounding. It became the blueprint for Berkshire Hathaway, really.
So that mindset, this sort of architectural view of capital, it wasn't just innate, it was built. And his education was, well, not exactly standard, right? Even though his dad pushed for college.
Right. He started at Wharton, then ended up at the University of Nebraska, studied accounting, which he always calls the language of business. But his real education, that was him driving himself. By 19, he'd read every investing book available, even tried technical analysis for a bit.
Oh, really? Didn't stick, I guess.
Nope. He realized its limits pretty quickly. And socially, he was apparently quite shy, not into small talk about, typical teenage stuff.
Okay.
But put him in a corner at a party, and suddenly he'd have a crowd listening to him talk stocks, money, business, just this insatiable curiosity, reading Moody's, S&P manuals cover to cover twice.
Soaking it all in. But you often hear about mentors. Was there someone or maybe a book that really cemented things for him early on? I know he got rejected by Harvard Business School.
Yeah, he calls that rejection a blessing in disguise because it led him to Columbia Business School, and there he found Benjamin Graham.
Ah, the father of value investing.
Exactly, co-author of Security Analysis. But it was Graham's other book, The Intelligent Investor, from 1949, that became Buffett's Bible.
Okay, so what were the big takeaways from Graham?
3 huge ideas, really. First, intrinsic value. The idea that a stock isn't just a blinking price on a screen, it's a piece of a real business. And that business has an actual underlying worth you can figure out.
Makes sense. What's number 2?
Number 2 is Mr. Market. This is just a brilliant analogy.
Yeah, tell us about that. How did Graham explain it?
Graham pictured the stock market as this, Manic depressive business partner, Mr. Market. Some days he's wildly optimistic, offers you a high price for your share of the business. Other days he's deeply pessimistic, offers to sell you his share for way less. The point is, Mr. Market's moods, his prices, they aren't necessarily reflecting the real value of the business. A smart investor uses those mood swings. Buys when Mr. Market is depressed and prices are low. Maybe sells when he's euphoric and prices are high. You don't let the market's emotions dictate your decisions. You see price changes as opportunities, not information about the business itself.
Right. Don't get caught up in the frenzy or the fear. And the third big idea.
Margin of safety. This is crucial. Always buy at a significant discount to that intrinsic value you calculated.
Like a buffer.
Exactly. A buffer against being wrong or just unforeseen bad luck. Graham's simple rule of thumb was buy $1 worth of securities for 50 cents. Calculate the net worth assets minus liabilities, compare it to the stock price. Look for that discount.
And Buffett just latched onto this.
Totally. He basically memorized security analysis, got an A+ from Graham, apparently the first Graham had given in 22 years.
Oh.
He even offered to work for Graham for nothing.
But Graham initially said no. That seems crazy now.
Yeah, apparently due to some Wall Street prejudices at the time about hiring non-Jewish people. So Buffett actually went back to Omaha, worked at his dad's firm for a bit.
But that period back home was important for another reason, wasn't it? Something beyond finance.
Absolutely. This is when he took that Dale Carnegie public speaking course. He hated public speaking, apparently.
Really, Mr. Buffett.
Yeah, but he knew he needed to communicate his ideas. He actually calls that course his most important degree. And he immediately put it into practice, teaching an investment course at the University of Omaha, basically teaching Graham's principles.
Okay, so he's got the Graham framework. He's honed his communication skills.
Yeah.
How did he first start putting this value investing into practice? What was the strategy?
This is where the cigar butt strategy comes in.
Right, I've heard of this.
He looked for these cheap, often frankly terrible companies that were so undervalued, they had like one good puff left in them. Meaning their liquidation value, what you'd get if you just sold off all the assets, was actually more than what the whole company was selling for on the stock market.
Okay, so truly bargain basement stuff.
Totally. He'd dig through Moody's manuals, these obscure pink sheets for thinly traded stocks, the National Quotation Book. Places where there wasn't much competition from big Wall Street firms, so you could find these weird bargains.
Like what? Any examples?
Sure. Companies like Sanborn Map, or National American, an insurance company where he literally went out and bought shares from farmers who didn't realize what they were worth, getting them at like a 70% discount. He was incredibly diligent, even met shareholders face-to-face sometimes.
That dedication paid off. He started his own investment partnerships in Omaha in '56, right? Pooled money from friends and family?
Yep, started with about $105,000. He was 25. And he set very clear rules for his partners. They got the first 6% return each year. Then he took his cut, 25% of the profits above that. And he told them, judge me over years, not months.
And it worked.
Oh, it worked. His goal was millionaire by 30. He hit it at 31. Between 57 and 61, his partnerships returned 251% cumulative. The Dow Jones, only 74% in that same period.
Huge outperformance. But then by 1969, things changed. He found it harder to find those cigar butts.
Exactly. The market got expensive, frothy. He felt the kind of bargains Graham taught him to find just weren't there anymore, so he did something pretty radical.
What was that?
He dissolved the partnership, told his partners he was out of step with the market, couldn't find value. It sounds like admitting defeat, maybe.
Yeah, or maybe setting the stage for something much bigger.
Precisely. It marked a huge turning point. A philosophical shift was coming.
And a key figure enters the picture here, or rather, becomes much more central. Charlie Munger, another Omaha guy. They met back in '59. How did Munger change Buffett's thinking?
Munger's influence was, well, transformative. It's a legendary partnership for a reason. Charlie pushed Warren beyond just buying cheap. He challenged the whole cigar butt thing.
How so?
Munger argued that buying mediocre businesses just because they were statistically cheap wasn't a great long-term strategy, especially as Buffett had more and more capital to deploy. It just didn't scale well. Munger's mantra was different. Buy great companies at fair prices.
Quality over just cheapness.
Exactly. Focus on businesses with durable competitive advantages, strong brands, good management. Munger helped Buffett see that paying a fair price for a truly wonderful business could be far more profitable in the long run than getting a bargain on a so-so one. It's about enduring quality, not just a quick puff.
Which is ironic because the company that became his vehicle, Berkshire Hathaway, was initially one of those cigar butts, right? A struggling textile mill he bought in '62.
Absolutely. Classic Graham purchase. Statistically cheap. But Buffett himself later called it a mistake, buying into a northern textile business destined to become extinct.
So how did that mistake become
Well,
Berkshire Hathaway as we know it?
instead of just liquidating it slowly, he started using its cash flow, small as it was initially, to buy other businesses. Insurance became key early on. He gradually, strategically transformed Berkshire from this dying textile company into a holding company, a conglomerate.
Diversified.
Hugely. Insurance, retail, energy, railroads, you name it. And this structure gave him incredible flexibility. He could take cash generated by one business, say See's Candies, and allocate it to another area with better growth prospects, all very efficiently, minimal corporate overhead. Moving, as he put it, huge sums to where they could earn the best returns.
And this shift to quality really shows up in the kinds of businesses Berkshire started buying. Tell us about some of the big wins under this Munger-influenced philosophy.
Well, See's Candies in '72 is a prime example. He called it a dream business. Why? Incredible brand loyalty, people loved the product, it generated lots of cash, and crucially, it didn't require huge amounts of capital reinvestment to keep growing, a total shift from cigar butts.
Right. What else?
Coca-Cola. Started buying heavily in '87. By 2021, those shares were up, over 5,500%?
Incredible.
Then there's Apple. He was kind of late to the Apple party, started buying in 2016.
Yeah, it seems surprising for him at the time, a tech company.
Right. But it became one of his biggest and most profitable holdings, up over 630% by 2021. These are businesses with immense brand power, customer loyalty, sticky businesses. Proving Munger's point. Paying a fair price for great quality pays off massively over time.
And beyond those headline names, you see it in holdings like Bank of America, UPS, Mondelez. But it wasn't always just about finding existing giants. Sometimes it was about seeing quality under pressure, like with American Express back in the '60s, the salad oil scandal.
That's a great story. Amex got hit hard. A client, a salad oil company, perpetrated this massive fraud using fake inventory as collateral. Amex technically didn't have to cover the losses from the banks who got defrauded, but there was huge pressure.
So what did Buffett do? He owned stock.
He saw the underlying strength of the Amex brand, the traveler's checks, the card business. He believed paying the settlement, even though it hurt financially in the short term, about $60 million, would actually strengthen the brand long term by showing they stood behind their name, that they were trustworthy.
A character move, almost.
Exactly. He supported paying it despite shareholder grumbling, and he was right. The brand endured, thrived even, and his investment made him about $3.5 million. It showed his focus on long-term reputation, not just the immediate numbers. He consistently looks for companies with strong balance sheets, low debt, and importantly, consistent earnings growth over years, ideally a decade.
And all this feeds back into that core compounding idea, but now on a massive scale within Berkshire. They famously don't pay cash dividends.
Right. Instead of sending profits out to shareholders, they keep it, reinvest it internally, buying more businesses or stocks, building taxable income year after year.
The scale of that reinvestment is just hard to grasp.
The numbers are wild. In 2024 alone, Berkshire paid $26.8 billion in U.S. corporate income tax. That's about 5% of all corporate income tax paid in America that year.
5% from one company.
Yeah. Buffett used this analogy. If Berkshire sent the Treasury a check for $1 million every 20 minutes, 2047, all through 2024, they'd still owe money at the end of the year.
That's mind-bending. And the result for shareholders who stuck with him.
Phenomenal. A share bought in 1962 for $7.50 was worth around $334,000 by February 2025. The overall gain for Berkshire from 1964 to 2024, over 5.5 million%. The S&P 500 in the same period, about 39,000%.
It just shows the power of saving, reinvesting, and letting time do its magic, as he says.
The magic of compounding amplified.
So, okay, beyond the investing genius, the Oracle persona, he shares a lot of wisdom about just life, business, making decisions. He's also refreshingly honest about mistakes.
Very much so. He talks about them openly in his shareholder letters, calls them capital allocation errors, basically, bad decisions about where to put money.
And that ties into Charlie Munger's view, right? About not delaying corrections.
Yeah, Munger called it thumb-sucking. Delaying fixing a mistake was the real sin. Buffett agrees. You can't wish problems away. You have to act decisively even when it's tough. Accept the error, learn, move on.
His way of managing people is also pretty different. He famously says he doesn't care where someone went to school.
Right, which is interesting given his own academic journey. He talks about people like Bill Gates, a college dropout, or Ben Rosner, who apparently only finished sixth grade but was a brilliant manager. He seems to value innate talent, intelligence, and integrity above credentials.
And letting them run their businesses.
Huge emphasis on that. Hire good people you trust, give them autonomy. But he's also pragmatic. He's acknowledged having to fire people, even friends, because ultimately his job is to allocate capital effectively for shareholders.
It seems like his broader views on the economy and society often reflect that same pragmatic, long-term perspective. He's very optimistic about America, isn't he?
Incredibly optimistic. Despite all the challenges you hear about, he calls the U.S. an absolute miracle. Points out that GDP per person is 6 times higher now than when he was born. He has immense faith in American innovation and dynamism.
But what about things like automation, job losses? That worries a lot of people.
His take is interesting. He sees automation, increased productivity as fundamentally good. It creates more wealth, more possibilities overall. The challenge for him isn't the automation itself, it's how the benefits are distributed.
So what's the solution then?
He suggests the government has a role in helping people who are displaced by these economic shifts. Things like retraining programs, but also direct financial support, like strengthening the earned income tax credit. He's less keen on things like big minimum wage hikes, worrying they might distort the labor market too much. It's about helping people adapt, not necessarily stopping the progress.
What about healthcare? That's another huge cost, a big issue.
Yeah, he's acknowledged it's a massive burden, 18% of GDP now. He talks about needing innovation, more efficiency. Berkshire was part of that Haven initiative with Amazon and JP Morgan for a while, trying to use their scale to improve care and lower costs for their own employees.
Right, that didn't ultimately take off, but it showed they were trying to tackle it.
It showed a willingness to try things outside the existing system, yeah.
And looking globally, what's his view on something like foreign aid?
His core belief there is that every life is of equal value. He argues that even though foreign aid is a tiny part of the U.S. budget, a dollar spent on health initiatives overseas can often save far more lives than a dollar spent domestically. He sees it as not just humanitarian, but also promoting global stability.
Which connects directly to his own massive philanthropy, the Giving Pledge with Bill and Melinda Gates, committing to give away almost everything.
Pretty much 99.5% of his wealth. And he follows through, just recently, a $6 billion donation of Berkshire stock. It's immense.
And this seems tied to his whole ovarian lottery idea. Can you explain that? It's quite a perspective.
It really is. He fundamentally believes his incredible success isn't just down to him being smart or working hard. A huge part of it, he says, is pure luck. Being born male in the United States in 1930, a time and place with incredible opportunity, rule of law, markets that allowed someone like him to thrive.
So basically, he won the lottery at birth.
That's his term. He feels he owes a debt back to the society that made his success possible. It's a really grounding perspective, challenges that whole self-made myth. It suggests your wiring, your temperament, sure, but also just the circumstances you're born into play a massive role, which ties back to his idea that temperament often matters more than sheer IQ in investing. Once you're past a certain point, maybe 120 IQ points, he suggests. Being rational, unemotional, thinking for yourself, that's key.
It's an incredible arc. From selling gum door to door, the shy kid, to the Oracle of Omaha, we've traced that early drive, the Ben Graham Foundation, the huge shift with Charlie Munger, building Berkshire into this compounding machine.
And seeing how his wisdom really does go beyond just stocks, management, society, philanthropy.
Yeah. And he keeps coming back to that idea. Success isn't just about brains, it's about wiring, temperament, and that ovarian lottery, that luck of time and place. And his point that time is maybe the biggest factor in making money.
What's a powerful thread through his whole story? Patience, long-term thinking.
So now, as he's planning to step down as CEO, Greg Abel taking over by end of 2025, it really makes you think, what is his legacy beyond just the billions? Especially now in this world of, constant information, short attention spans, economic shifts, his principles feel almost countercultural, but maybe more vital than ever. Patience, value, long-term thinking.
Absolutely.
Given his view that time's the biggest factor, and he's now stepping back, what do you think is the single most powerful lesson from Buffett's life for people navigating the world today?